Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis. We deep dive into financial, but we also tell you about the key risks and triggers going forward. Well, let's not waste any time. Let's get straight to the first stock today. My colleague Sonal, she travels to Hyderabad and gets us his very special deep dive on CCL Products.
The consumption of coffee is rising, and in that, the instant coffee market is also picking up. We are in Hyderabad to understand the business of CCL Products, instant coffee maker that has more than 900 coffee blends, 400 clients in 90 plus countries. It is on an expansion spree and is planning to increase the capacity from 35,000 tons in FY21 to 77,000 tons in FY25 with an investment of 1,050 crore rupees. Company has products like spray-dried coffee, spray-dried agglomerated coffee, freeze-dried coffee, concentrated liquid coffee, roast and ground coffee, roasted beans and premix, and coffee is sent to clients abroad like Jacobs, there's LMZ, Soluble Coffee, Extract Cafe, and in India to clients like Big Bazaar, Sleepy Owl, Reliance, Spencer's, Blue Tokai, to name a few. Now about the revenues. There are some segments here. FY23 revenues were at 2,071 crore rupees, out of which Continental Coffee is 10% of revenues, which has branded and private label. Standalone business is 44% of revenues, which is domestic bulk and export sales. Engon Coffee, which is Vietnam, is 32% of sales and 14% is from Continental Coffee, Switzerland. They get 12% from domestic sales and 88% from overseas sales. And if we look at the CAGR of the last 5 years, for revenues, it has come in at 17.6%, EBITDA at 13%, and PAT CAGR has been at 15%. Margins, after being around the 24-25% mark in the last few years, have come down to 19%. EBITDA per kg is an important metric to track for the company as well. In terms of key triggers, the focus on the branded business will be key to track, followed by market share gains in domestic and global markets. And this will be driven by capacity expansion that the company is planning. But to understand more about the strategy and take a deep dive into the business, let's go ahead and speak to the management. Okay, it's time to understand everything about CCL Products business. As promised, we have the Managing Director of the company, Challa Srishant, and he's here to tell us everything about the business and also how does instant coffee reach your home. Well, thank you so much for joining us on CNBC-TV18. It's a special show where we try to understand the business. So to the basic question first, can you explain us the value chain of an instant coffee? Where do you stand in that value chain? How is it made?
Okay. So broadly speaking, the coffee market is divided into two segments. One, you have the roasted ground coffee segment, which is what the coffee shops use. And the second is the instant coffee segment. This is where you have a lot of value addition that takes place. We do additional processing of the coffee to come up with an instant coffee powder that is shelf stable for at least 2 years' time.
Okay. So when we say that, can you give us an example as to how much quantity leads to how much coffee? Say if you use 1 kg of coffee seed, how much of an instant coffee is made out of it?
So typically we need about 2.5 kilos of raw material, that's green coffee, to come up with 1 kilo of finished product.
Okay. So when we are talking about raw materials, green beans are of course raw materials here. What does the sourcing look like? Because you do have factories abroad, you do have production in India. What is the split looking like?
So we end up actually importing a lot of our coffees from all over the world. We buy from Brazil, from Mexico, from Ivory Coast, from a lot of countries in Africa. We buy from Indonesia, Vietnam as well, and we also source within India. So we buy from all these locations, we do the value addition at our end, and then we export the coffee.
Okay. So how much of your dependence would be on imports? Trying to also understand, say, once coffee prices shoot up, does that cyclicality impact you?
So right now about 10% of our coffee is being procured within India because Indian coffee commands a very high premium. And if you want to import coffee for the domestic market, there's a 100% duty. So it's not viable to use imported coffee. So for the Indian market, we use Indian coffee. And if there is any specific customer who's looking for a premium grade or a premium quality, then we use Indian coffee for exports as well. And as far as the cyclicality is concerned, we work in a cost-plus model. So whatever is the raw material price at a particular point in time, we use that as a base and make an offer to our customer. So even if it's a one-year contract, we do a back-to-back contract with our suppliers so that we are covered. So the only way that we grow normally is by increasing our volumes year on year. That's how we've come. We started with a 3,000-ton factory. By next year, we're going to about 77,000 tons.
Okay, and that is one trigger everyone's watching out for as well. So you spoke about 77,000 tons per annum would be your capacity. How much is it as a part of the entire instant coffee market?
See, the overall instant coffee market is guesstimated to be around 900,000 tons. So with the 77,000 tons, we will be the second largest manufacturer in the world next year. Okay,
second largest manufacturer. Okay, that's amazing. So, you spoke about how volume growth is something that will lead to growth as well going forward, and pricing is a function of cost plus method. But is pricing competitive? Because we do have a lot of competitors in the instant coffee market as well. Is pricing an advantage for you? How do you look at that dynamic of the business?
So for us, our primary advantage is economies of scale, and we have the ability to import raw materials from any origin. So today, Brazil is the largest manufacturer in the world, but they have to use only local raw materials. They can't use raw materials from different origins the way we can. We have invested in technology and innovation over the last 15-20 years, so we can actually match products using different grades, different qualities from different parts of the world. So that gives us a competitive edge over everyone else. Okay,
interesting. So now we have to understand more about the cost part, because you have low cost of production, right? Can you split it up for us? What does it look like in the packaging side? What is it like in transport cost? How do you ensure that there's low cost of production? You spoke about how sourcing is something that makes you competitive. Is there anything else that you focus on as well?
So when you actually break it down costing-wise, about 70% of your product costing is raw material itself. Out of the balance, 30%, you have your conversion cost based on your location. You'll have a marginal difference between our conversion cost and other countries' conversion cost. The raw material is the main area where we end up focusing on. We ensure that we get the right raw material to get the right finished product. We've been able to match qualities using alternative raw materials to give options to customers. So that is the flexibility that we have. So our plant also has been designed in a manner, it's been customized in a manner to basically use any type of raw material to get the finished product that we desire. Okay, so when you do have to increase prices on the cost plus method, there is no impact on demand as such, that stays as is. Because there is a demand for the coffee which is not going to reduce irrespective of the coffee prices. And by virtue of our technology and our ability to service customers, match products, we know that we can service any customer anywhere in the world. So naturally, we have the ability to increase our volumes disproportionate to what rate that the market is growing. Okay, so in that 77,000 tons per annum, the capacity that you're increasing, there's spray-dried and freeze-dried. First, I would like to understand the difference here. And I was looking at the margins. Spray-dried, that's going to see a higher capacity addition versus freeze-dried. But freeze-dried margins are higher. So can you explain, will that continue to be the mix for you? So typically what we do is we first expand spray, then we go for freeze-dried expansion, then we go back to spray and then freeze again. So in the recent past we've completed our spray-dried expansion. Now we're going to do our freeze-dried expansion in Vietnam, which is going to come online next year around this time. Okay, and what's the difference between the two? So the two qualities are, so spray-dried is where you heat up the product to about 200 degrees temperature, 200 to 260 degrees temperature, and you spray the product from a 40-meter high tower. So there's a heat application. Now the aroma and everything which is there in coffee are all volatiles. So when you apply so much heat, automatically the volatiles get evaporated. So there's a deterioration in quality that takes place.
Okay.
But freeze drying is a process where you take the product to minus 60 degrees temperature and then process and make the product. So you lock in the aroma, you lock in the flavor profile, you create a significantly more premium product by doing that. So physical characteristics also will change. I can actually show you some products also. For example, this is a freeze-dried coffee. You can see that the structure of granules is very different from a spray-dried coffee. This is a spray-dried coffee where you can see it's just plain powder.
Oh, okay.
So there's a physical difference in the products.
Okay, so it's a masterclass not only for investors but every coffee lover who loves to brew their own coffee or buy it from CCL Products. But thank you for explaining that to us. You spoke about your growth will come in from volumes as well. So what kind of volume growth are you looking at with the new capacity coming in? When will it see full level of capacity utilization? And what happens to return ratios once these new capacities come in, because they will not be working at full capacity utilization initially, right?
Yeah. So one good thing for us is it takes about 30% utilization itself is enough for a break even for us. When we have to go in for expansion, we don't directly go in for expansion first. We first start building a market, and only when we are confident that we can sell more, we go in for our expansion. So what we did in the last couple of years was we started outsourcing our production to other manufacturers as well. Now that we've built up a customer base, we have that confidence that we can go in for further expansion. And first year itself, we are operating at about 50% utilization. And we're looking at increasing our overall volumes at a 20% year on year. So we are confident that our ratios will definitely, initially, obviously the ratios will deteriorate, but in the next couple of years, automatically that will improve significantly.
Okay. So, I have a lot more questions for you, but since you showed me the coffees, I think we should have one cup and then continue with this conversation.
Sure.
Okay, so you're making me some coffee?
Yes, so both have been pre-configured. You just have to tap this and you'll get your coffee.
Should I just tap?
Just tap it down.
Alright, so while we are at it and we pick this nice looking coffee, B2B versus B2C. There has been a change in your idea as well, and you're focusing on B2C a lot more. What will the mix look like going forward? How are you focusing on marketing on this one?
So the B2C segment is something that we were quite interested in because that's where the valuation of a company unlock actually takes place, and building a brand is not an easy task. So we started this as an experiment about 6-7 years ago. Then we reached a certain minimum scale that we felt that we should professionalize and take it forward. And after professionalizing, our volume started growing as well. So that helped us come up with a long-term vision or a strategy where we want to transition from a B2B to B2C. So this transition will take a couple of years, of course. But the idea is that maybe over the next 7 to 10 years, we want to have at least 50% of our business coming from B2C segment.
Okay, so when we talk about that, it's 10% of your business right now, still loss making, right? So
we've broken even actually.
Okay, you've broken even now. So what will the growth on the profitability look like there? What is the volume growth outlook here? You did give us a sense of what it will be as a percentage of overall revenues down the line. But in terms of profitability, what will it look like?
So actually the target that we've given our team is that focus only on volume growth, profitability, ensure that there are no losses. So the reason for this is we know that our core business is anyway growing at a very good healthy pace, and we can sustain this B2C business as well without it actually contributing to the bottom line. So that's the reason the team has clarity. They know that they're supposed to focus only on volume growth, at least for the next couple of years. So eventually when it starts contributing, when our B2C sales also start reducing after a certain point in time, that's when the B2C will start stepping in as well.
Okay, so what are some changes that you're planning to do in that case? Will you increase your market reach, distribution? Will it mean more expenditure on that side?
So yes, we are increasing our distribution reach not only in India, we're looking at launching our products in different parts of the world as well. So we've acquired this brand called Rocket Fuel and Percol in the UK. So with our brand presence over there also, we are slowly transitioning from the B2B to B2C.
Okay, so when we talk about those changes as well, this question has been asked to you a lot of times, but are you looking at a new FMCG head there? Will it be a separate entity altogether? Will you look at listing it as well? Because you spoke about this business getting higher valuation.
So initially we thought we will separate it, but today we're actually in the process of demerging and merging it with the parent company. We're consolidating the entire coffee business under one roof. So from next month onwards especially, the entire B2B and B2C verticals will be under the same company.
Okay, so no plans of demerging, looking at it as a separate vertical and listing it or anything?
No, not
and
right now.
You're looking at a separate head, FMCG head for that business?
No, so our CEO right now who's in place was brought in for this specific purpose. So he's building his team as well. So he's bringing in a lot of new people for the international market as well, for the new areas that we are going to be launching our products also.
Okay, so you are talking about focusing on the B2C business. You spoke about this segment as well. What will EBITDA per kg look like? I'm not asking about margins because you have told us in the past EBITDA per kg is important to track. And what would be a possible downside risk to all the guidance or projections that you have in place?
So with respect to our core business, which is now 99% is coffee, less than 1%, less than 0.5% of what we do will be these niche products and categories. So in the near future, we don't really see any significant change as such. We are looking at growing this B2B segment much more aggressively as well. So we are confident we can sustain our margins as well. In fact, if we have to fill our capacities, if we have to grow by a 40% year on year, we have the ability to do that if we sacrifice on our margins. But we are not doing that. We want to grow in a more sustainable manner. Okay,
20% volume growth with sustainable margins is what you're looking at. Okay, it was a strong interview that we had, a conversation that is. Thank you so much for joining us today and explaining to us everything about CCL Products and the outlook as well. Thanks a lot.
Thank you.
Okay, with that, it's a wrap on this segment, and with that, it's back to you in the studios.
All right, that was a deep dive into CCL Products. But time to slip into a short break. We'll come back with another interesting stock that we're going to explain to you. Uniparts, that's the stock on our Swotlight segment. You don't go anywhere. Welcome back to Inside Out. Well, Uniparts is the stock on our radar, and as you can see, post its listing in December 2022, the stock price has done absolutely nothing. Well, let's educate you first on the business aspects. The company is a leading supplier of systems and components for off-highway vehicles. It's one of the only major players who combines their cost-competitive India manufacturing and global delivery capabilities. Well, the company has been a partner of choice for global leaders in the agriculture and construction, forestry and mining segments. Their key clients as well should come up for you on the screen, with John Deere being one of its key clients, contributing nearly around a third of its total revenues. They supply critical load-bearing products that are subject to strict tolerance, specifications and process controls, which require long approval times, and hence they enjoy super profitability and return ratios. But I'll get to that in just a bit. Let's explain to you the key products, which include 3-point linkages, which is also known as 3PL. Precision machine parts, which is also known as PMP, along with a recent foray into adjacent product verticals like hydraulic cylinders and power takeoffs. But let's explain the function of each of these segments. 3PL helps in quick and easy attachment and detachment of implements from tractors. PMP is made to tight tolerances and durability to withstand the tough operating environment of offshore highway vehicles. These are high quality and reliable components for use in construction machinery, equipment and structures. Well, let's get to their market share then globally. They command 16.7% in the global 3PL market and 5.9% in the global PMP market. Well, over the last 3 years, the company has grown at a CAGR of close to around 15%, with margins moving to around the 22% odd mark. However, the start to this fiscal has been slow, with a weak showing in the first quarter. There was revenue degrowth, though they managed to hold their margins at around 20%. That's a little bit encouraging. Well, the key reasons for the disappointing quarter one showing is that the small agriculture market demand continues to be subdued in North America. Aftermarket segment has remained soft for a little longer than they anticipated earlier in the Europe as well as the US market. And demand in the Indian tractor market had a slow start to the year. Well, the global tailwinds include India emerging as the preferred manufacturing hub, supply chain disruptions led by the pandemic, and global uncertainties have led to manufacturers looking beyond China. And also the US $1 trillion infra bill that's expected to boost demand for construction equipment as they aim to modernize their aging infrastructure assets. Well, in terms of the company-specific triggers, Uniparts has developed a 3PL system for utility terrain vehicles, which opens up a whole new market for them. Additionally, they are the preferred supplier for manufacturers of sub-70 HP tractors globally, but now they intend to focus on increasing their market share on the customer spend per vehicle by manufacturing 3PL products for tractors with more than 70 HP. The company is also focusing on expanding its share of warehousing sales, which will drive profitability, as they intend on taking this segment to around 47 to around 46% of its mix in the coming years. Finally, they're also focusing on growing the adjacent segments, which as of now are relatively small, but whose market is 10 times bigger than its existing market size of 3PL and PMPS. What works with the company is it trades at around 13 times, which is not very expensive, though we need to see growth pick up. But they have support because of the clean balance sheet, which puts them in a good place to grow inorganically, and further supported by solid ROCE and dividend payout ratios. Well, let's wind this down with the shareholding pattern. The promoter entity, well, it has close to around 65% stake in the company, and also they have participation coming in from institutions as well. Well, we've completely run out of time on this edition of Inside Out. It's goodbye from Sonal and myself, but you do write to us and tell us about companies you want us to discuss. We'll try to feature some of them on the show. Thanks so much for watching.